A Business Money Management Guide. Business Money Introduction. You need money to start a business, to stay afloat during hard times and to expand. Every business runs on money. Even non-profit businesses need money to continue and expand. They hire professional fundraisers to help them raise money. I noticed websites like Patreon.com and PayPal.me springing up along with crowdfunding, Kickstarter, GoFundMe, Indiegogo. People think up business ideas and go on these websites asking for help. This is one way to get initial startup capital. The other traditional ways are: do it yourself, starting small on a shoestring. Try for a bank loan. Max your credit cards out. Try to attract investors. Look for programs, contests, etc. that help new business owners. I tried to cover the entire spectrum of money in business, including all the fraud in business. I'm sure I've seen every episode of the TV show American Greed. If you don't watch your money like a hawk, your employees or customers will figure out a way to get it. Businesses exist to make money, not only for the owner and workers to earn a living, but most business owners secretly want the big score, for their business to make so much money and expand that they get on the cover of Forbes magazine and have enough money to do whatever they want that money can buy. A lot of people say that they start businesses to help people and fill a need. I don't care about motives. I care about the bottom line, which is that you need to at least break even and hopefully make a profit in order to continue on as a business. Thousands of businesses start every year. Thousands fail for a variety of reasons. The biggest reason could be cash flow. You can't cover your bills. This is why any business must be cautious of expansion. A business doing all right can go under if it expands and can't pay its bills. You, the business owner or manager, have to know intuitively how much money you're spending and how much you're taking in roughly and specifically. You have to take a look at every bill because there is fraud on business everywhere. There was an inventory guy who created a fake account for a supplier to the business he worked for, but it was really that guy making up fake bills and pocketing the money. People make up fake bills and send them to businesses as cleaning services, property tax insurance, a parts supplier, accounting services, legal services, etc. They bank on the fact that a few business owners will pay without questioning it. You can never trust anyone with your money, including lawyers, accountants, and the big accounting firms. Many of the big accounting firms have gotten in trouble. They go to court and pay their fine. You're still liable for whatever charges you have, even if they screwed up your income tax bill. Many accounting firms lie and pretend they can save you money on income tax, but if they're caught messing with the law, the responsibility goes back to you to pay the bill. Some accounting firms have even pocketed the money a company puts up to pay taxes by offering to pay on their behalf. Then they either declare bankruptcy or they're long gone when the tax man catches up to them. Cash flow management is all about managing your money, making sure you have a positive cash flow all the time, more dollars in assets than liability dollars out, getting money from your customers quickly, keeping your accounting system simple, keeping all your money in one bank account to keep it simple, paying your bills timely as late as possible if necessary, and keeping an eye on taxes you owe. Some people seem to want to pay bills as late as possible in order to keep their money on hand in case they need it and to collect daily interest from the bank, but I'm of the mind to do this only if you're really low. Other than that, pay your bills as quickly as possible to get it over with. The stress of this trivial matter overrides the main concern of business, which is to create a good product to help people. Cash is king. Too many self-employed people neglect their cash flow until it is too late to recover. Cash flow is all about getting the money from customers, paying your bills, keeping it simple, one bank account, managing accounts payable, accounts receivable, and inventory more effectively while being frugal. What it really comes down to is getting your money from your customers quickly. That's what cash flow management is. In your business, you should collect money as fast as you can. To do so, try these things. Payroll is a mess. And it's not just government withholding for Social Security, state taxes, unemployment, Medicare, and workers' compensation. There's the group health insurance plan, which you'll probably take a deduction from the employee's paycheck for, and the retirement savings plan for your employees. You can find part-time workers or independent contractors to avoid this headache, but with many businesses, especially as they expand, this is not possible. Either get a good software program or hire a payroll service to handle it all. You could do both. Do what you can yourself on the software and give it to your tax guy to finish it off. Bootstrap management is a term used to describe being cheap. Cut costs from within and generate money any way you can when in a tough situation. I've watched businesses on TV on some of those case study business shows. They want nice offices with decor. They pay a plant service to bring in fresh plants and stuff like that. You're running a business, producing a product or service. That's it. Forget about wasting money on the frills. One guy said he judged CEOs by how well dressed they were. The less well dressed they were, the more he trusted that they were hardworking, honest people. Businesses get in trouble all the time. I'm sure I've seen every episode of the TV show Bar Rescue with John Topper because I'm curious to watch how failing bar owners operate. Many live in denial. They kind of give up and keep going until the landlord or foreclosure agent comes to lock the doors. Many people simply want to do what the business does as in production and they don't want to deal with the money, but you cannot trust your accountants and lawyers, so you, as the business owner or manager, must always know where your money is, how much is coming in and being paid out and to whom. Chapter 1. Accountants and lawyers can save you lots of money. You need an accountant and a lawyer. A lawyer is a liar. An accountant is a ledger in his own mind. Even the smallest and newest business needs help from at least two kinds of specialists. An attorney. An accountant. Depending on your type of business and your skills, you may, from time to time, ask the advice of other professionals such as a marketing specialist, an insurance representative, management consultant, a computer specialist, a realtor, a public relations expert, etc. Several guidelines will hold true no matter what type of expert you are dealing with. 1. Interview professionals to see if you will be comfortable working with them. Make sure they have served other small businesses similar to yours. Find out ahead of time exactly what service you are buying, what the working relationship will be and what fees will be charged. 2. Be honest about your business situation. Advice based on partial or incorrect information is no advice at all. If you are having problems, don't be embarrassed. If your sales are down, give the experts all the information you have and work as a team to solve the problem. If business is good, don't be afraid that professionals will steal your idea or expect a raise. Build a trusting, business-like relationship. 3. Expect the professionals you hire to spend at least some of their time teaching you and explaining complex concepts, but don't expect to be spoon-fed or delegate all decisions to them. Take a course at the local community college in record keeping and taxes or public relations to develop more skill in areas where you are inexperienced. 4. Keep your appointments and pay your bills promptly. Chapter 2. Financial Planning in Business. C. The following chapter is a brief summary of much more detailed information at sba.gov. Business Financial Planning. There is one simple reason to understand and observe financial planning in your business: to avoid failure. 8 of 10 new businesses fail primarily because of the lack of good financial planning. Financial planning affects how and on what terms you will be able to attract the funding required to establish, maintain, and expand your business. Financial planning determines the raw materials you can afford to buy, the products you will be able to produce, and whether or not you will be able to market them efficiently. It affects the human and physical resources you will be able to acquire to operate your business. It will be a major determinant of whether or not you will be able to make your business profitable. Very simply stated, financial management is the use of financial statements that reflect the financial condition of a business to identify its relative strengths and weaknesses. It enables you to plan using projections, future financial performance for capital, asset, and personnel requirements to maximize the return on shareholders' investment. The tools required to prepare a financial plan for your business's development include the following: basic financial statements, the balance sheet and statement of income. Ratio analysis, a means by which individual business performance is compared to similar businesses in the same category. The pro forma statement of income, a method used to forecast future profitability. Break-even analysis, a method allowing the small business person to calculate the sales level at which a business recovers all its costs or expenses. The cash flow statement, also known as the budget, identifies the flow of cash into and out of the business. Pricing formulas and policies used to calculate profitable selling prices for products and services. Types and sources of capital available to finance business operations. Short and long-term planning considerations necessary to maximize profits. These concepts are deep. You don't have to analyze your business to death, just know what's going on. There are two primary financial statements, the balance sheet and the statement of income. Financial statements. Most business owners like sales and production and hate the tedious job of keeping track of what's going on money-wise, credit versus debit. This section covers the bare-bone basics and reminds you that you gotta keep on top of the books if you wanna stay alive. For more info, check out the number 657 section of your library for business accounting books and go to sba.gov for free publications. All too often the owner is so caught up in the day-to-day tasks of getting the product out the door and struggling to collect receivables to meet the payroll that he or she does not keep good financial records. Often new managers understand their products but not the financial statements or the bookkeeping records which they feel are for the benefit of the IRS or the bank. Such overburdened owners/managers can scarcely identify what will affect their businesses next week, let alone over the coming months and years. Focusing on planning is essential to survival. Short-term planning is generally concerned with profit planning or budgeting. Long-term planning is generally strategic, setting goals for sales growth and profitability over a minimum of 3 to 5 years. The long-term or strategic plan focuses on statements of income prepared for annual periods 3 to 5 years into the future. Granted, it's hard to imagine all the variables that will affect your business in the next year, let alone the next 3 to 5 years. The key, however, is control of your business's future course of expansion through the use of financial knowledge of your business, namely, how much you're spending, how much you're taking in, how much loss can you stand before the business gets profitable, and how you'd like to expand. All businesses run on money for the purpose of making money. If you don't plan financially, you're like a ship without a rudder. Although it is nearly impossible to make exact estimates, approximate ones will help. The very process of thinking through these financial questions will develop your business acumen and lead to solid planning. Get your accountant involved in reviewing your plans and advising you to begin your financial planning by estimating your initial or startup costs. Include all items of a non-recurring nature such as fees, licenses, permits, franchise fees, insurance, telephone deposit, tools, equipment, office supplies, fixtures, installation of fixtures and equipment, remodeling and decorating, funds for your opening promotional event if you plan to have one, signs and, of course, professional fees for your attorney and accountant. Depending on your type of operation, the amount of money you invest and the energy you expect to put in, part-time to full-time, can determine how much working capital you will need. If you expect a profit in 6 months, double that time and be ready to operate without profits for 12 months to give yourself a cushion in case of unanticipated expenses or delays. Study the growth patterns of other similar business and ask for advice from your accountant and attorney. Estimate the working capital you will need to keep operating for 6 to 12 months. Operating expenses include salaries, expenses for telephone, light, heat, office supplies, and other supplies or materials, debt interest, advertising fees, maintenance costs, taxes, legal and accounting fees, insurance fees, business membership fees and special services expenses, such as secretarial, copying and delivery service. After you have estimated startup costs, working or operating capital needed for 6 to 12 months, and personal expenses and obligations, you may see that you need more startup capital than you thought. Discuss this with your accountant, attorney, and trusted business associates and family. In addition to business operating capital, you will need to plan for reserve capital to cover personal expenses. This estimate will include all your normal living expenses, such as food, household expenses, car payments, rent or mortgage, clothing, medical expenses, entertainment and taxes for you and your family. Your balance sheet is a summary of the status of your business, i.e., its assets, liabilities, and net worth at an instant in time. By reviewing your balance sheet along with the profit and loss statement and cash flow statement, you will be able to make informed financial and business planning decision. The balance sheet is drawn up using the totals from the individual accounts kept in your general ledger. It shows what you have left when you pay all your creditors. Assets less liabilities equal capital or net worth. The assets and liabilities sections must balance, hence the name balance sheet. It can be produced quarterly, semi-annually, or at the end of each calendar or fiscal year. While your accountant will be most helpful in drawing up your balance sheet, it is you who must understand it. Current assets are anything of value you own, such as cash, inventory, or property that the business owner can convert into cash within a year. Fixed assets are things such as land and equipment. Liabilities are debts the business must pay. They may be current, such as amounts owed to suppliers or your accountant, or they may be long-term, such as notes owed to the bank. Capital, also called equity or net worth, is the excess of your assets over your liabilities. Prepare a balance sheet for your new business during the planning phase to estimate its financial condition at that time, and also a projected one for the first year of business. This will help you decide on the feasibility of your venture and make modifications to ensure profitability. You can also use these statements as part of the documentation in a loan application. Your profit and loss statement is a detailed, month-by-month tally of the income from sales and the expenses incurred to generate the sales. It is a good assessment tool because it shows the effect of your decision on profit. It is a good planning tool because you can try out decisions on paper before actually going ahead. The profit and loss statement includes 4 kinds of information. The sales information lists the number of units sold and the total revenues generated by the sales. The direct expenses category includes the cost of labor, materials, and manufacturing overhead but not normal overhead. Indirect expenses are the costs you have even if the product is not produced or the service is not delivered. They include the fixed costs or normal overhead of salaries, rent, utilities, insurance, depreciation, office supplies, taxes, and professional fees for your lawyers and accountant. Income or profit is the last category on the profit and loss statement. It is shown both as pre-tax and after-tax or net income. The IRS will look at your pre-tax figure, whereas your loan officer and you are more concerned with your after-tax figure. Your profit and loss statement should be prepared at the very minimum once a year and more often in the beginning or growth stages of your business. It is a key document from which the economic health of a business can be determined. Make certain you do it properly and understand its meaning. Your business must have a healthy cash flow to survive. To keep tabs on cash flow, forecast the funds you expect to disburse and receive over a given period of time. Then you can predict deficiencies or surplus in cash and decide how to respond. A cash flow projection serves one other very useful purpose in addition to planning. As the actual information becomes available to you, compare it to the monthly cash flow estimates you previously made to see how accurately you are estimating. As you do this, you will be giving yourself on-the-spot business training in making more accurate estimates and plans for the coming months. As your ability to estimate improves, your financial control of the business will increase. The creative business owner works with his or her accountant to use the information gleaned from his balance sheet to make a variety of managerial decisions on buying supplies, expansion, when to hire more employees, how to get the best tax breaks, and many other important steps that will shape the future of the business. SBA.gov, booklets about financial planning for business. Operating ratios. Operating or financial ratios are different formulas that use a variety of variables from the financial numbers of the business to end up with a number that is then compared to industry standards to see how it rates. Think of it as a number that compares typical expenses to run certain types of business with typical money coming in, and from this, you can get a probability as to whether the business will make it or not. It's a good idea to obtain typical operating ratios for the kind of business in which you are interested. Among the sources for such ratios are Robert Morris Associates, Dun & Bradstreet, Inc., the Accounting Corporation of America, trade associations, publishers of trade magazines, specialized accounting firms, industrial companies, for example, National Cash Register Co., and colleges and universities. The typical ratios for your type of business combined with your estimated sales volume will serve as benchmarks for estimating the various items of expense. However, do not use this method as gospel. It's just a technical way to analyze the possible future success of your business. In my opinion, it's still not as powerful as gut intuition. Most industries track the following formulas/ratios in their field. Profit margin: how much of each dollar you bring in do you get to keep as profit? Sales per employee: look at the norms for your industry. If your sales per employee are way below it, you're overstaffed. Sales per product line, per store, per salesperson, per office, etc. You can calculate sales on any variable you want, then plot it on a graph as you go along to see how you're doing. The higher the sales per unit of your variable, the better. Cost of goods sold, COGS: most industries have a standard for expenses as a percent of revenue. Selling expenses as a percent of revenue: most industries have a standard for this ratio. G&A, general and administrative, expenses as a percent of total expenses. The lower you can get this without sacrificing sales, the better. The best sources for industry ratios are to contact your trade organization and ask if they do this type of research. If they do, buy a membership to get this information. If they don't, read the different publications in your field to look for this type of research. The balance sheet. The balance sheet provides a picture of the financial health of a business at a given moment, usually at the close of an accounting period. It lists in detail the material and intangible items the business owns, known as its assets, and what money the business owes, either to its creditors, liabilities, or to its owners, shareholders' equity or net worth of the business. Assets include not only cash, merchandise inventory, land, buildings, equipment, machinery, furniture, patents, trademarks and the like, but also money due from individuals or other businesses, known as accounts or notes receivable. Liabilities are funds acquired for a business through loans or the sale of property or services to the business on credit. Creditors do not acquire business ownership but promissory notes to be paid at a designated future date. Shareholders' equity, or net worth or capital, is money put into a business by its owners for use by the business in acquiring assets. At any given time, a business's assets equal the total contributions by the creditors and owners, as illustrated by the following formula for the balance sheet. Assets equals net worth, liabilities. This formula is a basic premise of accounting. If a business owes more money to creditors than it possesses in value of assets owned, the net worth or owner's equity of the business will be a negative number. The balance sheet is designed to show how the assets, liabilities, and net worth of a business are distributed at any given time. It is usually prepared at regular intervals, e.g., at each month's end but especially at the end of each fiscal, accounting, year. By regularly preparing this summary of what the business owns and owes, the balance sheet, the business owner/manager can identify and analyze trends in the financial strength of the business. It permits timely modifications, such as gradually decreasing the amount of money the business owes to creditors and increasing the amount the business owes its owners. All balance sheets contain the same categories of assets, liabilities, and net worth. Assets are arranged in decreasing order of how quickly they can be turned into cash, liquidity. Liabilities are listed in order of how soon they must be repaid, followed by retained earnings, net worth or owner's equity. An asset is anything the business owns that has monetary value. Current assets include cash, government securities, marketable securities, accounts receivable, notes receivable, other than from officers or employees, inventories, prepaid expenses, and any other item that could be converted into cash within 1 year in the normal course of business. Fixed assets are those acquired for long-term use in a business such as land, plant, equipment, machinery, leasehold improvements, furniture, fixtures, and any other items with an expected useful business life measured in years, as opposed to items that will wear out or be used up in less than 1 year and are usually expensed when they are purchased. These assets are typically not for resale and are recorded in the balance sheet at their net cost less accumulated depreciation. Other assets include intangible assets, such as patents, royalty arrangements, copyrights, exclusive use contracts and notes receivable from officers and employees. Liabilities are the claims of creditors against the assets of the business, debts owed by the business. Current liabilities are accounts payable, notes payable to banks, accrued expenses, wages, salaries, taxes payable, the current portion, due within 1 year, of long-term debt and other obligations to creditors due within 1 year. Long-term liabilities are mortgages, intermediate and long-term bank loans, equipment loans, and any other obligation for money due to a creditor with a maturity longer than 1 year. Net worth is the assets of the business minus its liabilities. Net worth equals the owner's equity. This equity is the investment by the owner plus any profits or minus any losses that have accumulated in the business. The statement of income. The second primary report included in a business's financial statement is the statement of income. The statement of income is a measurement of a company's sales and expenses over a specific period of time. It is prepared at regular intervals, again, each month and fiscal year end, to show the results of operating during those accounting periods. It too follows generally accepted accounting principles, GAAP, and contains specific revenue and expense categories regardless of the nature of the business. The statement of income categories are calculated as described below. Net sales, gross sales less returns and allowances. Less cost of goods sold, cost of inventories. Equals gross margin, gross profit on sales before operating expenses. Less selling and administrative expenses, salaries, wages, payroll taxes and benefits, rent, utilities, maintenance expenses, office supplies, postage, automobile/vehicle expenses, insurance, legal and accounting expenses, depreciation. Equals operating profit, profit before other non-operating income or expense. Plus other income, income from discounts, investments, customer charge accounts. Less other expenses, interest expense. Equals net profit, loss, before tax, the figure on which your tax is calculated. Less income taxes, if any are due. Equals net profit, loss, after tax. Calculation of the cost of goods sold category in the statement of income, or profit and loss statement as it is sometimes called, varies depending on whether the business is retail, wholesale, or manufacturing. In retailing and wholesaling, computing the cost of goods sold during the accounting period involves beginning and ending inventories. This, of course, includes purchases made during the accounting period. In manufacturing it involves not only finished goods inventories but also raw materials inventories, goods in process inventories, direct labor, and direct factory overhead costs. Regardless of the calculation for cost of goods sold, deduct the cost of goods sold from net sales to get gross margin or gross profit. From gross profit, deduct general or indirect overhead such as selling expenses, office expenses, and interest expenses, to calculate your net profit. This is the final profit after all costs and expenses for the accounting period have been deducted. The cash flow statement. The cash flow statement identifies when cash is expected to be received and when it must be spent to pay bills and debts. It shows how much cash will be needed to pay expenses and when it will be needed. It also allows the manager to identify where the necessary cash will come from. For example, will it be internally generated from sales and the collection of accounts receivable or must it be borrowed? The cash flow statement, based on management estimates of sales and obligations, identifies when money will be flowing into and out of the business. It enables management to plan for shortfalls in cash resources so short-term working capital loans may be arranged in advance. It allows management to schedule purchases and payments in a way that enables the business to borrow as little as possible. Because all sales are not cash sales, management must be able to forecast when accounts receivable will become cash in the bank and when expenses, whether regular or seasonal, must be paid so cash shortfalls will not interrupt normal business operations. The cash flow statement may also be used as a budget, permitting the manager increased control of the business through continuous comparison of actual receipts and disbursements against forecast amounts. This comparison helps the small business owner identify areas for timely improvement in financial management. By closely watching the timing of cash receipts and disbursements, cash balance on hand and loan balances, management can readily identify such things as deficiencies in collecting receivables, unrealistic trade credit or loan repayment schedules. Surplus cash that may be invested on a short-term basis or used to reduce debt and interest expenses temporarily can be recognized. In short, it is the most valuable tool management has at its disposal to refine the day-to-day operation of a business. It is an important financial tool bank lenders evaluate when a business needs a loan, for it demonstrates not only how large a loan is required but also when and how it can be repaid. A cash flow statement or budget can be prepared for any period of time, however, a one-year budget matching the fiscal year of your business is recommended. As in the preparation and use of the statement of income, the projected cash flow statement should be prepared on a monthly basis for the next year. It should be revised not less than quarterly to reflect actual performance in the preceding 3 months of operations to check its projections. In preparing the cash flow statement, start with the sales budget. Other budgets are related directly or indirectly to this budget. In order to make the most effective use of your budgets to plan profits, you will want to establish reporting devices. Throughout the time span you have set, you need periodic reports and reviews on both efforts and accomplishments. These let you know whether your budget plan is being attained and help you keep control throughout the process. It is through comparing actual performance with budgeted projections that you maintain control of the operations. Your company should be structured along functional lines, with well-identified areas of responsibility and authority. Then, depending upon the size of your company, the budget reports can be prepared to correspond with the organizational structure of the company. Remember, the cash flow statement used as the business's budget allows the owner/manager to anticipate problems rather than react to them after they occur. It permits comparison of actual receipts and disbursements against projections to identify errors in the forecast. If cash flow is analyzed monthly, the manager can correct the cause of the error before it harms profitability. Business financial planning websites. SBA.gov, booklets about financial planning for business. IKEA.com/finance/small_business_financial_planning.asp. Business.com. CFObusinesspartners.com. hss-inc.com/1-1-services-business-planning.htm. nationalcity.com/planning/financial planning/business-planning.asp. paloalto.com/ps/business-planning.cfm. quicken.intuit.com. sba.gov